Hi guys, good afternoon and welcome to Your Stocks. I'm Pavitra. With me is Ekta as always. And for the market, things are really picking up after that initial dip that we did get. We're now seeing around a 72-point gain on the Nifty. The broader market is pretty much in line as well. So the mid-cap index has seen an over 140-point recovery from the lows, and it is around 0.3% higher as well. Banks have been a little bit of, the muted part of the market, and we did see some cuts there earlier as well. But Ekta, parts of the market, pharma for instance, really holding it together today.
Absolutely, Pavitra. Just before we wrapped up on mid-cap radar, that's exactly what I was pointing out, that there are so many stocks within the pharmaceutical space where there's been a margin improvement which has come through. So, for example, we were talking about Kaplan Point. That stock is higher in today's trading session because there has been a margin improvement which has come through. We also have something like Morpen Labs, which is higher because of a better amount of margins. And even Eris Life Sciences, which just came out with numbers, and that too has seen a margin improvement all the way to 36%. So you can see that that seems to be the key theme which is playing out in today's trading session, not to mention that we have Yatharth Hospital, which has seen a good listing as well. But nonetheless, we do have Ashish Kyal from Wave Strategy as well as Shahina Mukadam, who are an independent market expert, to answer all of your stock queries. Well, I'll just take Pavitra's point forward and start the show, Shahina, by asking you about a lot of these pharmaceutical stocks which have reported what seems to be a better quarter.
Well, yes, actually, after a difficult 6 months, numbers have started looking better. We are seeing the impact on raw materials and availability of raw materials also improving. So I think it is the sector is underheld, and I think, stocks should consolidate and do better from current levels.
Okay, got that. That is on the pharma pack. Of course, we've already seen a big rally in that entire index this whole year. But let's get down to the queries as well. We have Swati, who writes in from Pune. She holds 30 shares of Paytm at 400 and is making profits in her investments. She's a medium-term investor and wants to know whether she should buy more new age stocks or she should get out. Of course, today is a great day to be discussing Paytm because of the news flow that came through this morning. Shahina, your call on Paytm, and then she's also asking if she should look at other new age stocks. There's been a lot of chatter, whether it was Zomato, earlier as well, declaring profits ahead of what was expected. Today, again, the stock is up around 5-6%. What do you think about Paytm in specific and the other, other new age companies as well?
I think, I would classify them as high-risk stocks when the market itself is at highs. Basically, Paytm, Zomato, they have shown a substantial improvement in numbers. But, if, like, for example, Zomato, they were profitable. They have, of course, turned cash positive. At the same time, the profits have come from some tax write-back. So I think while volumes are looking up, and even for Paytm, a similar story where you have impact going forward, that is likely on higher finance costs, and valuations of both of them are extremely rich. So any disappointment going forward, a retail investor is likely to see, stock coming off. And for an institutional investor or somebody who has this as a very small part of their portfolio, I think it makes sense because they're new age, as you described it. And if you're willing to, take the losses, hold it for 5 years, yeah, these are the better stocks in their portfolio. But I would keep strict stop losses if I'm holding both of them, and I would not be buying them at current levels.
Okay, well, on the technicals, how would you approach them, Ashish?
See, if you look at Zomato, Paytm, many of these new age stocks have shown a very sharp rise, and Paytm has shown a gap up opening around 853 levels. So the overall tone is positive, but I would not ask her to buy at these levels because the stocks have already rallied. Rather look forward for booking some partial profits in Paytm and use the gap area, which is around 790, as a stop loss, and keep trailing that. So book partial profits, get out from here, and possibly not reinvest into new age stocks because all of those have already rallied and discounted a lot of things, and possibly look forward for the blue chip stocks right now.
Okay, all right. So that's the view coming in on Paytm and a couple of these new age counters. Just to put it into perspective, Zomato has also got one of the highest turnovers in today's trading session in terms of volume. So that's the kind of interest that you're seeing. Remember, it's been in focus because it reported its first ever maiden profit as well. So that stock is close to around 100 odd rupees in today's trade. But let's get to another query then. We have Rahul Batra, who writes to us from New Delhi. He holds 20 shares of M&M, which is bought at around 400 rupees. Medium-term investor wants to know what to do, whether he should stay invested or sell. Well, it seems as though he is currently a long-term investor, Shahina, but what would you recommend on M&M, considering a lot of the news flow with regards to the investment in the financial space and, question marks regarding the intention there. But nonetheless, despite the clarifications, but what would your thought process be on M&M and whether one should book profits?
Well, the investors gotten at decent levels, and I would suggest that while the RBI, the bank investment in RBL Bank was an overhang, I think the management has gone around to clarify that this is a financial investment, and in the very long term, they would look. On the other hand, in EV, they have sort of raised funds, and they seem to have more clarity on how the EV business will evolve, and it looks good. So I would continue holding and keep reviewing it after every, 6 months, a year, but it's a hold.
Okay, hold on M&M. Ashish, would you agree as well? I mean, this stock has seen a 22% rally in this year. Do you think you would still stay invested in this one?
Yes, absolutely. Because see, if you look at the entire auto space and auto ancillary, they have been outperforming for quite some time. And we can clearly see that outperformance even in M&M. The stock started rallying at around 1140, which was in April, and right now we can clearly see a good move on the upside. So the overall trend for the stock is positive. I would recommend that if you want to add more to these levels because we are getting some consolidation and correction over past few days. So the levels are good to add the stock. On the downside, maintain a stop loss of 1420, and we can expect the stocks to even cross about that 1600 mark and possibly reach towards 1650 levels.
Okay, you got that. So both of our guests agreeing that this is a good one to hold, even though the stock has rallied significantly. The next query comes in from Rahul Batra. He writes to us from New Delhi. Okay, this is actually the one that we've already taken. The next query is from Shweta Mathur, who writes to us from Bhopal, and this is also about the auto pack. So, you are seeing a lot of investor interest over there. Now, she holds 10 shares of Tata Motors, which she bought at 300 rupees a piece. Long-term investor again, and wants to know whether to hold or sell. So, the stock is almost double of, the buy price. Ashish, what would you recommend on this one? Because this stock has also seen a big rally this year. But do you think, considering that this is a long-term investor anyway, you should just keep this one? And this is one of those stocks that you hold on to?
Yes, indeed. First, I would like to congratulate the person invested at 300 and still holding. That's a very good sign. Not anyone holds more than 100% return, right? And from here, I would continue to recommend a hold here because the stock has potential to even cross that 900 levels on the upside. So I'm bullish on the entire auto space, and Tata Motors looks very promising because the stock just started rallying from around the lows which was formed in April. And I think this is just the first leg of the rally, and we will see the third leg, which is usually the most strongest and the momentum based. So from here, hold on to the stock. Target levels remains 900, which is, I know, very high, but I think that is achievable. And on the downside, any dips can be used as a buying opportunity.
Okay, well, Shahina, you were just mentioning about EVs and M&M. Tata Motors is looking to really bolster its infrastructure when it comes to its EV portfolio as well, maybe even a separate sales team. What would you recommend on the fundamentals?
I would agree. I think the stock looks good despite having run up. You have JLR, which has started doing very well. You have raw material prices that are coming off. The supply and availability of chips is eased out. All things work out for, Tata Motors, even at current levels. So I would give it a hold.
Okay, hold on Tata Motors for both of our guests. Let's also get in our next query. This one is on Zomato. So, like we were pointing out, there's a lot of interest in these new age companies. We have Jaspal Singh, who writes in from Chandigarh. He holds 25 shares of Zomato, which he bought at 90 per share. The stock is currently close to around 100. Now, he wants to know whether he should hold or sell. He's a medium-term investor and is asking whether he should stay invested in this one. Shahina, we were just discussing the space, but, considering that he's got in at around 90, do you think for now you should stay invested or, would you recommend getting out?
Well, I would stay invested with a 100 rupee stop loss because, the profit that they have made is, as I said, through some tax write-off. And you can see ups and downs. So keep a stop loss and then take your money off the table if you're getting, profits. Keep strict stop losses in such stocks.
Okay, well, we've already addressed a lot of these counters. But as of now, Ashish as well as Shahina, we're going to take a quick break. But we have a lot more queries lined up, so stay tuned. Welcome back. Well, you're still tuned into your stocks. We have Ashish Kyal on the technicals and Shahina Mukadam on the fundamentals to answer all of your stock queries that we have this Monday. Well, we have another query now. We have Vijay Kamath, who writes to us from Bangalore. He holds 25 shares of Sanofi, which he's bought at 7,900 odd rupees, and 100 shares of Gland Pharma, which he's bought at 3,200 odd rupees. He's holding these stocks for a year now. He's a long-term investor and wants to know what to do, whether to hold or sell at current levels. Well, you know, Shahina, we've been talking about how the healthcare and the pharmaceutical space has done so well, but there are definitely some laggards, and obviously one which comes to mind is Gland Pharma, considering that it has seen a lot of margin pressure, raw material, supply chain pressure, etc. So that is one stock where there is a query on what to do with that particular counter. The buy price is over 3,000 odd rupees. And Sanofi is seeing an upside today because there's some positive news at the parent level. But nonetheless, what do you expect on Sanofi? Do you think that it could probably inch back to that buy price of 7,900?
Well, coming first to Gland Pharma, I've always had a negative call on the stock simply because of the valuations earlier when it first, had rallied a lot. And then, of course, because of the issues on raw material and raw material availability, and, the raw materials have remained at a, decent level, the cost wise, but at the same time the selling price was lower, and this hit them badly in terms of profitability, and we saw the stock decline substantially. Investors have lost a lot of money. Now at current levels, if you ask me, if somebody is holding, I don't see any point in selling at current levels, because I believe now on both factors, raw material as well as on revenues, if you see over the last quarter, the numbers were pretty bad. I think it will consolidate and remain at more or less at those levels, and valuations have started looking better. So I would not sell at current levels. And coming to Sanofi, which is a subsidiary of Hex, of course, they showed very good numbers. The global, the parent. And I think the rally that has happened is because they had announced a couple of months back that they would demerge their consumer business. They've got strong brands into a separate, subsidiary, and then list it. And there, I believe, which accounts for about 30% of their revenues. So I think an investor at current levels can continue holding, wait for the demerger, and then probably review, your holdings in both of them. So I would say hold for both the stocks.
Okay, hold for both the stocks. By the way, those are Emami's numbers flashing on your screen. Revenue growth has not been too high. It's just around 6% higher over there, 825 crores. The net profit seems to have jumped to around 137 crores. This stock has not done much at all. If you look at a year-to-date chart, a one-year chart, it's been quite flat. Right now, it's picking up a little bit because the initial numbers do look quite all right. Shahina, your thoughts on Emami, and is this something that you feel is a good investment opportunity at current levels?
Well, I think valuations for Emami have now started looking better, and I think they have got a number of products in the pipeline and which they're launching, especially in their consumer division. So I would say that it looks decent in the overall FMCG pack.
Okay, well, it'll definitely be interesting to hear what Emami has to say after Britannia did indicate some amount of competitive pressure. So whether or not Emami, obviously in a different segment, is facing any kind of competitive pressure. That stock up around 0.8%. We have Gaurav Parab, who writes to us from Nasik. He holds 100 shares of NMDC, which he's bought at 110 rupees, and 50 shares of UPL, which is bought at around 575. He's a medium-term investor, wants to know what to do with both these holdings, whether he should hold or sell. Ashish, what would you recommend on the technicals for both of these?
See, if you look at NMDC, the stock has corrected from 130 levels, came down and formed a double bottom around 105 and showing some kind of an attempt on the upside. But over past 3 to 4 days, again started showing correction. So there is not much that we are seeing in this space, and NMDC has not delivered any kind of returns over past 1 year if you look at that. But having said that, I think it is better to hold on to the stock as of now. Maintain a stop loss on the downside at 107, and if the stock manages to cross back about that 116 mark, then we can expect it to go towards 125, where you can possibly look forward to book the profit. So 125 can be the target, with a stop loss on the downside at 107 for NMDC. And for UPL, we can clearly see a very sharp cut has been witnessed in this stock from around 750 levels, and it is now right now trading at 607. It is not managed to show any kind of a pullback. I would recommend it's better to be out from here because we are not seeing any kind of a reversal sign. But if still wants to hold and maintain a strict stop loss of around 590, if the stock breaks 590, then the downside momentum can increase. And on the upside, I think the stock will find hurdle to cross even 640. So exit from UPL and possibly hold on to NMDC.
Okay, got that. I also want Shahina's views on this. Shahina, specifically on UPL, the earnings were weak. I mean, I think across the board, we also saw brokerages bring down their target price. What do you think of this one, and would you recommend getting out?
See, I totally agree with the technical view. The fundamentals support the technical view on both the stocks. So for UPL, I would exit given the fact that the numbers were poor, and I expect the pressure to continue going forward into the next couple of quarters. So while of course valuations have become cheap, it's become cheaper. I think this factors more into the negativity that will come in the next couple of quarters in terms of how the numbers will look. So I would exit. And in terms of NMDC, I totally agree. While the volumes, the company has said that they have done extremely strong production numbers for this quarter. But if you see prices of iron ore, they are at about $100 currently, which is about 20% lower. So I think this will, lower prices will sort of offset the high production, and the number should be decent. So you keep a stop loss because valuations are very attractive. It's just about 3.5 times, 4 times EV by, I think it's EBITDA. So 4 times, so I would just hold.
Okay, all right. Let's get in another query now. We have Manjusha, who writes to us from Bhopal and holds 20 shares of Thangamile jewelry at 1410. Medium-term investor wants to know what to do, whether to hold or sell this particular counter. Any thoughts on this one, Shahina?
Well, this is how, small investors may lose money. The numbers were extremely strong. And on that, the investor has gone on, in my view, given the stock price, has gone on and bought it at a high. Now, what I would say that is, you keep a strong stop loss and continue to hold, and let's hope things look better. But gold prices are coming down. So we will have to see how it evolves. Valuations, are reasonable, not cheap, not expensive. So they will have to perform going forward. Keep a stop loss.
Okay, and I think at 1410, this would be investing at the absolute highs, right, on Thangamile, and it has come off a bit since then. But Ashish, how is this one looking to you on the charts? Because, for a couple of months, we saw a complete one-way rise on this stock. What do you have to say about this stock and how it's looking on the charts?
See, the chart looks okay, but the investment price is way too steep because the stock started rallying from around, I think, 760 levels, and the investment is done at 1410. That is very high, and from there we have seen some kind of a correction. So, but on the downside, there is a 61.8% retracement level, which is at 1100. So I would suggest use a strict stop loss of 1100. Just in case the stock breaks 1100, it's better to book losses and be out of here. And just in case if it manages to protect that 1100 mark, consolidates for some time, we can expect the stock reaching back toward the investment value, which is at 1410. So be out of the stock at 1410 if it is near the cost price, or if 1100 breaks. So that's the stop loss.
Okay, all right, Ashish as well as Shahina, thanks very much for joining in and taking us through all of those queries. Well, overall, it is a quiet market with definitely a positive bias. We have the mid-caps, which have definitely picked up pace, along with the Nifty, which is closing in towards 19,600. We already touched those levels on an intraday basis. So let's see whether we make a dash for it towards the last hour of trade. Well, that's all the time that we have in the show, but do remember to email us all of your questions and we will be addressing them as always with our experts. Stay tuned, closing bell up next.